the US economy, it's still clearly growing, but we have what we call lagging and we have leading indicators. And the leading indicators, unemployment are lagging, by the way. It shows what's in the rearview mirror. But leading indicators tell us where the economy is probably going. Consumer sentiment, for example, it's a very important bellwether. It has eroded from the first quarter. You can see the numbers there. High prices chipping away at confidence. Factory orders is also, particularly at the factory gate, it can indicate where the economy is heading. Manufacturing contracted in July for the fourth straight month. And there's little doubt the economy is slowing. The Fed is certain almost, well, just about to cut rates. It's whether that it's going to be 50 basis points or 25 basis points, and whether or not it's going to have a technical recession on the way as well. Randall Kroszner is a former Fed governor, now professor at University of Chicago Booth School. Joins me now, I think, from Munich. All right, Randall. Now let's take this bit by bit. First of all, I assume, having seen these numbers, you believe you're certain that the Fed is going to cut in September, but are you a quarter or a half?
Well, they still have a lot more data to take into account. We're going to see the employment report 1 month from now, beginning of September. Some people have argued that this was weaker because of some special factors. People always come up with some special factors. The special factor of the month was the weather that hit Texas.
Right.
And so there were a lot more people who were reporting that they were not working because of weather-related issues. So my guess is this is a little bit worse than it otherwise would be, but I think it is part of a broader slowdown.
Right, but so a cut in September, half or 50?
For sure. And so I think it'll really depend on that
Right.
employment report at the beginning of September. If it comes in, if this is just seen, if we continue to just move down and much more weakness, it'll be 50. If it bounces back a little bit, it'll be 25.
Okay, now we were talking earlier, just a moment or two ago, you may have heard me say, if you look at the amount of rate cuts that there were 2 years ago into 18 months ago to the last one last year, and you bear in mind the monetary lag, and we're looking at a graphic which does show this sort of all those cuts and then extrapolated out, say 9 to 12 months on. It's not surprising that we are seeing this slowdown, and there's an argument this is exactly when you would have seen it, and potentially it should be much greater.
So I totally agree that the classic thing that Milton Friedman, great University of Chicago professor, said 70 years ago was that monetary policy has impact with long and variable lags. And so we think of that as sort of like 9 to 18 months or maybe even 2 years. So exactly as you were just showing, what you're going to see is that in, starting in, a few months ago, some weakness, some slowness coming from that. And it's really only recently that the real interest rate, that is when you adjust for inflation, has become positive. And so that's when you finally get monetary tightening, when real interest rates, the inflation adjusted interest rate, is positive.
So factoring that in, and this is a sort of dancing on the head of a pin, I suspect, because has the FOMC left it too late to stop the snowball coming down the mountain before it does too much more damage? I mean, that's what's happened, really, hasn't it? They've started this snowball down the mountain, and it's picking up more and more and more momentum. And now they're going to hope that they can actually stop it before it becomes a recession.
Exactly. And one of the reasons that they took the risk that they might have that snowball going too far is because they didn't want to have a repeat of what happened in the late 70s, early 80s. When inflation came down a bit, they gave the all clear, cut interest rates, and then interest rates had to go up much, much higher to double-digit levels. So they want to take out that risk. So they were willing to take a little more of a risk of the snowball coming down. And I think now what's going to happen is, later this year, people will say, oh, the Fed was much too slow. But if they'd moved too quickly, then inflation could have come back up.
Right, and we've seen that in the EC, we've seen that in the Eurozone, and we've seen it in Canada, where whether or not we can link it directly to the interest rate cuts, I don't know. But they have cut, and inflation is going up again. And the other positive thing on this thing, Randall, which I know you'll have looked at closely, 2 years ago we said that the Fed had no I was going to say ceiling, but I really mean a floor to lower rates. So when you're down at zero, there's nowhere to go. Now they've got lots of room for traditional monetary policy to act.
Exactly. And so that's exactly what they're going to do. And as we were just talking about, if the labor market really seems to be coming apart, and we'll see that in, if you have September also having a very weak number, then they're going to move much more rapidly. Just as they move very rapidly on the way up, they'll move rapidly on the way down. Will that stop the snowball? I'm not sure.
Actually,
but they can
just
at least
a quick thought on that.
Sure.
Since inflation has already come down, right? Bearing in mind, inflation being high took people's money out of people's pockets. But since inflation's already come down, should we expect a monetary lag on the downside to be similar to that on the upside?
So it's likely to be. It'll have some lag. Will it be as much? Not so clear.
Right.
But there will be a lag. So even if they started cutting at the previous meeting, that's going to stop the snowball at least continuing part of the way down the hill.
Thank you, sir. I'm grateful. Enjoy Germany and look forward to talking to you soon. Thank you, sir.